we talked about a little bit of the misconception that it's all or nothing, right? When someone trades down in value, obviously what we have is boot, right? If they're not reinvesting those proceeds, there's some boot left over. How does that tax? Like, talk a little bit, is it a percentage? How's that get taxed? Is it from that end?
100% of boot is going to get taxable until your gain amount is raised. Let's say you sell the property and your gain is only $50,000, but you took $100,000 from the deal, then you're not going to pay, and not everything is taxable. $50,000 is a base, it's not taxable. So boot gets taxed up to your gain amount. But most of the time in this kind of transaction, people take boot is always 100% taxable because it's always a huge gain anyway, and that's why people do 10-35 exchange.
Right.
So it's still taxed at a capital gain tax rate, depending on long-term, short-term. It's mostly long-term problem most of the time on this 1031 exchange. You have state tax rate, your capital gain tax rate, which is maximum is 20% capital gain. State tax rate can be in the 5, 6, 7 depending on the state you live. And net investment income tax is another 4% depending on your tax bracket. It's taxed as capital gain. You don't pay any depreciation recapture, but when you take that capital gain out, that boot, there's a portion of that is going to be depreciation recapture, could be taxed at 25%. So many moving factors there, right? But it's not a marginal tax rate, meaning ordinary 37%. It's still a lower tax rate. That's what I'm trying to say.
Yeah, you can kind of see how it just becomes more complex. There's so much more involved, and like we said, we always want to talk to the CPA because there's just so much more that can be involved with just selling that property, how it was reported, how it was held, everything that goes along with it. Is that just one portion of the property of your overall tax picture? That makes sense from that end.